ladies and gentlemen, boys and girls, animals of all kinds, dear creatures from the space, welcome to your favorite podcast, Růžička and Wojciechowski. As we always say with Jan, who is not here, unfortunately, because of other duties, we don't know much, but we know it. So we love to invite a clever guest to our podcast. And today is your happy day because we have two guests here. Both are from United States, but one comes from Britain. Is it right? So it's my great pleasure to welcome Josh Lipsky, Senior Director of the Atlantic Council's Geoeconomics Center, and Charles Litchfield, Director of Economic Foresight and Analysis at the Atlantic Council's for Geoeconomics Center. Sorry, it's a pleasure to have you here.
Thank you for having us.
I thank you as well. And this episode will be about China, especially about its international position. And the first question is about surpluses. China is undoubtedly an export powerhouse, but mainly, in my opinion at least, in absolute terms. We have a chart here in the studio where you can see the current account balance in time. And if we look at the trade balance and current account surpluses relative to GDP, China is not among the countries with record numbers, like, for example, Japan, Germany, or even some other South Asian countries. So I would like to know, isn't the accusation of China causes global trade imbalances somewhat exaggerated?
So we'll start off by being a little controversial, which hopefully will set the tone for the whole conversation. Thank you for having us. Excited to be here. Fan of the podcast, so thanks for having us. No, it's not exaggerated. And let's start from the premise that the data here on the chart is probably not accurate.
Okay.
And the best way you can reconcile that, and you can go to the analysis for those who want to read about this online from Brad Setzer at the Council on Foreign Relations, who has done great work on this, is to try to reconcile China's customs data with what you're seeing here. And the numbers simply don't add up. It is hard to take in and out what's coming from the country based on what we know from trade and port and customs data and look at this data and say this is actually China's current account surplus relative to GDP. It's probably underestimated by hundreds of billions of dollars. And so therefore, just on a basic number level, even if we say this is what it looks like, China is exporting far more than is officially reported. And this is how we know it's happening, because anecdotally around the world, you see the pressure. And you see the pressure not just in the Western economies, not just in the US and Europe. You see it in emerging markets. You see it in Brazil. You see them saying, we feel a flood of Chinese exports in our economy in a way we have not in the past 5 years. And we need to put up protectionist measures against that. And that's a signal that what we're seeing in the official data isn't actually being reconciled with what's happening on the ground. So China is experiencing and is producing the second China shock in the global economy right now, running the largest trade surplus in the history of the world at $1 trillion. So of course, relative to the size of their economy, the second largest economy of the world, when you divide it by GDP, it may not look as a percentage as significant as Germany and others. But when you think of the aggregate shock on the global economy, it is unlike anything we have ever seen, because now it is not just a Western China shock, a US and Europe China shock, it's a global China shock. And we could talk about the specific sectors. So that's my view of where we are in the China shock.
Nothing to add. I just say that it's become a problem for Europeans, for the US, perhaps a little bit earlier, and perhaps they have a few more tools to deal with it. So you see the G7, where there's a lot of disagreement, a lot of things that they don't see eye to eye on. But on this problem, I think for this year's G7, it will be a huge focus. And China won't be present at the G7. There was actually a rumor that France might try to invite China so that they could discuss this very issue under the diplomatic banner of global imbalances. That's not what's going to happen. So they will be able to discuss it as a G7 in June. And then they will try to put together a roadmap which can be offered to the rest of the G20, including China, towards the end of the year. We don't think that such an ambitious strategy is wrong. It doesn't necessarily mean it will work this year. These are huge problems built up over many years. But that's just to give you some idea of how much of a focus it is for all developed countries, and of course for developing countries too. But developed countries have the tools perhaps to address it more than the developing markets do.
By the way, Donald Trump is not going to China in April.
Right.
It will be probably in May. But do you expect anything from his visit to China, especially when you have mentioned the G7 and other meetings probably? So what is your opinion on it?
Well, I think the best thing we expect out of it is status quo in the trade relationship. So nothing gets worse and we keep tariff rates where they are. And I do expect whenever the meeting happens, if it's May at this point, what we're tracking, it could get pushed again depending on how Iran develops because neither side wants to be doing this in the middle of the war. But whenever they meet, I think you're going to see some kind of announcement from President Trump about Chinese investment in the U.S. And this is something, as you've seen in other countries, he loves to tout. If it's Japan, if it's Indonesia, if it's India, this is the commitment. Now, of course, with China, that's more politically sensitive in the U.S. when you talk about Chinese investment in the U.S., which is why they already talked about last week creating this managed trade commission between the U.S. and China to screen what kind of investment China would make in the U.S., which is a signal that they want to make some kind of announcement about a big number that China is going to invest in the U.S., but also don't want to have political backlash in the U.S. about what those investments would mean from either an economic or national security perspective. So I think that's what we'll see whenever the meeting does take place.
And then there's just the parts on purchase agreements. You saw a smaller scale Canada, China. It was important for Canada to get just a few little lines in there on the sale of canola. For the US, it will be soybeans and perhaps also some planes. So a little bit more high tech than canola. But I think there's something to be learned from this, that the US economy is obviously very sophisticated and has some of the highest and most advanced tech, including on chips. But there are also dependencies that are much more low tech that China can use to coerce the US.
Yeah, that's right. We would like to talk about Chinese investments not only in the United States later. But the second question, I would like to stay at the problem of surpluses, because one of the key macroeconomic causes of China's current account surpluses is probably the high savings rate of Chinese households. We can see here on the chart that it's not about how distributed it is, but when you earn more, you save more. So it's really typical for Chinese, and the Communist Party is trying to address this for about 10 years through various measures, but nothing has worked so far. So what would need to happen for Chinese households to increase consumption and reduce its rate of savings?
Well, this is, of course, the question that President Xi and all the economic advisors in China have asked themselves for more than a decade now.
But if you could advise them something.
Well, they haven't asked for my advice yet, but we'll see if that changes in the years to come. But first of all, let me just say, this is great data and great charts. And we at the Atlantic Council love great data and great charts. And we love a podcast that incorporates good charts. And I think this also brings out some of the geographical differences in the country, which are important. From a U.S. perspective, we sometimes talk about China as monolithic, China this, China that. But like any country, there are differences between region and demographics. And it's important to
otherwise,
in
case of the United States, because the United States is similar to China. It's similar. In,
similar geographic issues. So all of these kind of divergences between the country. To drive consumption-driven growth, there has to be a shift away from the savings model into the investment model, but you can't have it while the property sector is under duress, because the average Chinese citizen right now is looking at their only base investment and feeling like it's at risk or being depreciated or at least not appreciating in value. And as long as that continues in the Chinese economy, the ability to change from a savings to a consumption-driven model cannot happen, because there's too much pressure and risk for most Chinese citizens right now to shift in what what they're doing. Now, there's all kinds of measures the party is trying to take on the margins. We study China's digital currency, ECNY, which is one of these measures they take. One of the interesting things about their CBDC, ECNY, is that it has the ability to disappear if you put it in someone's wallet. So I give you 3,000 yuan, and it disappears within 3 weeks. That's a fiscal stimulus because you better spend it, otherwise you're losing it. So they're tinkering, the PBOC and others can do, but that's on the margins. That's not going to change these macro numbers because there is no easy answer to that question.
Okay.
And then a pretty basic point, sorry, but worth making. One factor that contributes to households saving more is that they don't expect to receive much of a pension. So you hear all of these points about Europe having too generous a social safety net and China needing to invest in its own. And the high savings rate and the over-reliance on exports rather than consumption can also be explained through the fact that China has not really invested in its social safety net recently. I mean, it is the People's Republic of China, so it has a history of having a social safety net, but China has evolved massively and become a much richer country, and that social safety net hasn't been kept up to date. And I think for pensions especially, state pensions, or making sure that people don't have to save simply through their savings accounts, but perhaps could save a little bit more intelligently and through investment. I think we'll get to that soon, that topic. But those would be perhaps policies that could mean that Chinese households would feel more confident in consuming now. For now, they feel they definitely have to save.
Yeah. So that's your advice, in fact.
Well, yes. I mean, as Josh said, we are aware of what goes on in China. We follow closely. They follow what goes on in the US closely. Part of that dialogue, of course, goes through think tanks. But we have not received official requests for consultancy by the Chinese government yet.
All I would say to the Chinese policymakers listening is that the leaning in on the export-driven model, while it makes sense, understandably, given the lack of viable alternatives domestically, will continue to trigger a backlash around the world. And so it's not sustainable in the medium term.
But I suppose they know it.
They know it, but they don't have an option to shift back to the domestic consumption, and that's the tension.
Okay. So for several years, we've been observing a global process of deglobalization, and in case of China, it's because the surpluses are still higher, so it's not seen, but we can see it through decoupling with United States, or the trade between these two countries, and direct trade. We have to emphasize it. Direct trade between China and United States fell dramatically in the last year by more than 20%. However, some goods still reach the U.S. market indirectly. We have to mention it as well. And as you have already mentioned, Chinese are interested to invest in the United States, and they are trying to enter the market via Mexico or Canada, especially car manufacturers. If I've right information, probably only Polestar is on the U.S. market from Chinese brands, I suppose.
I think that's right.
Yeah,
and very small.
Yeah, and very small, of course.
But they had their showroom on the same street as our think tank in Washington.
Oh, really?
DC.
Right.
It's closed now.
Yeah.
And maybe a factory.
We walk by it all the time.
And maybe a factory, because Volvo does have factory in the United States, isn't it?
Volvo does.
Volvo,
yeah, and
Volvo.
I guess through Polestar.
And Polestar is part.
Yeah.
In fact, it's difficult in the structure of Geely, but it's like a sister company or sister brand or something like that. But do you expect that the decoupling between two countries will continue in the future, or could it change, for example, under new U.S. administration?
Great question. So the first point, as you raised, is we have to be careful with this because there is transshipment going on.
Okay.
And you certainly see a spike in transshipment, especially from Southeast Asian countries, Vietnam and others over the past year. So you can basically understand what's happening. That being said, there has been a reduction in exports from China to the U.S. There's no doubt about it, and tariffs are the catalyst for that. It's rare you see a chart with such a direct correlation to a policy decision and then the actual outcome in the policy decision reflecting what we think the administration wants from tariffs, although we could debate what the multiple goals are from tariffs. So does the decoupling continue? Yes, in some sectors. And I think EVs is not an area where China will find success in the United States because the politics around cars in the US are so fundamental to our system, the operation of Detroit, Ford, GM, and others. The idea of dropping the 100% EV tariffs that the Biden administration put on feels politically untenable right now. But that does not mean in other sectors that China will not find room to collaborate with the U.S. And you see the Trump administration saying there are sectors outside of national security where we can do more business and should do more business with China. And they're talking about that right now. It will be one of the outcomes of the visit. So the question is, can you separate what are sensitive sectors, what are national security related sectors, what are critical sectors for the future of the U.S. economy, semiconductors and otherwise things that feed AI versus basic goods and services. The problem is it's sometimes hard to separate those two. China makes it difficult to separate those two. It can be confusing what is the dual use of some of these products. And the politics of the U.S. are such that any kind of Chinese import triggers a backlash. But it is impossible to fully decouple these economies without massive rupturing of the global economy. And I think both sides experienced that a year ago when we went through Liberation Day and then the trade war between the two. So now they're trying to find their way back to what managed trade looks like between the countries. So slow decoupling in some sectors, but a continuing of trade links in other sectors is what I would predict.
Great.
Nothing to add.
Yeah, that's all. Everything has been said. Yeah, I agree. So the other side of the trade surplus is deficit on the financial account. Of course, it's a macroeconomic point of view. Capital, therefore, naturally flows out of China. In the history, primarily through the Belt and Road Initiative, but now the Chinese companies are going global independently, let's say. For example, Alibaba or Meituan, because Meituan is actually present in Brazil with its service Kita or something like that. I don't know exactly. So do you think that these, especially technological companies, have a chance to succeed internationally, especially given the previous attempts that were not very successful?
You want to start?
China's attempts to diversify, well, not too surprising. I don't want to disagree with the premise just when we're starting, but one thing I'd recommend is comparing this and these volumes, which seem impressive because they're in the billions, seem big, to, for instance, mutual investment between the US and the EU, which is in the trillions still. So it shows you how far behind China is in these investments. It shows you that it's only starting to reinvest its financial account into markets that are more mature. And so that would be one point I'd make first, that these are impressive numbers, but China is still far behind and playing catch up. That would be the first point. The second point is that some of this gets politicized very quickly. So in that 200 billion figure in the US, you have some real estate and also some land, and this is extremely controversial. The US federal government has its own mechanisms and policies for screening investments. And in the US, when you declare something as relevant to national security, you can go pretty quickly. And if you have a problem with a certain type of investment, you can ban it. But the US does need to be careful. It does need to seem a welcoming place for investment. And so sometimes things get through at the federal level, but then at the state level, the investment becomes controversial. And so
maybe that was the question, whether the technological companies can replace the old kind of investments into properties with their own, because Alibaba is investing in the United States.
I would hope that they can diversify their investment and we can find an understanding that doesn't encroach on things that the US cares about, like national security. It's controversial when tech gets involved in investment because of the data involved. And so you saw this whole episode with TikTok, which was a fully owned Chinese app belonging to ByteDance, but the US now there's a sort of new separate US entity which now belongs to US investors. So I think that might be another thing that's keeping China from going into the more sensitive high-tech areas, because the US cares about the data and doesn't really want that to be shared with the US. So I'm talking for too long now, but that was my attempt to unpick the 200 billion in the US. On the European side, I just have a few points, and we could go look at everywhere, but I'll talk about the European side before passing over to Josh. In Europe, there is a more welcoming feeling still about Chinese investment. There is a feeling that China now has more advanced technology than some European sectors, and it is less controversial in Europe to welcome Chinese investment where we just can't compete. So where in the US, there may be a sense that this is still about US intellectual property. And if China is investing in specific US companies, they want the IP. In Europe, for instance, on electric vehicles, there's a feeling that China's more advanced than us. And so if they invest and build a factory in Europe, at least this isn't jobs for us. And we can even use our laws to insist on some technology transfer. So the philosophy is completely different. But I'll return to my first point. These numbers are impressive, but they're small compared to US-EU investment.
The only thing I'd add is that there's very few things the Biden and Trump administration agree on. But one thing I remember is that Secretary Raimondo, who was the Commerce Secretary in the Biden administration, came to the Atlantic Council a few years ago, and she was asked about Chinese EVs. And she didn't say they compete with our U.S. car companies, and so we have to have tariffs on them. She said they have sensors in their cars that could drive by secure facilities in the U.S. and collect data, and that's why we have to prevent them from getting in here. So to Charles' point about technology, it's going to be very hard for Chinese tech from a U.S. perspective to expand in a significant way. It's one area where there's bipartisan consensus in Washington.
So maybe I don't know whether you have answered the fifth question, but I will ask it despite of it because you are right, and especially several countries have forbidden Chinese cars to enter military objects already, including Israel, for example. I think Sweden, so in Europe as well, but the car industry is in China the primary or maybe dominant export sector now. It's driving the export not only to the, let's say, developing regions, but also in Europe. So do you think that China will dominate in automotive industry in general, because China is investing in EV in Europe. They are building factories, they are creating joint ventures as well. So do you think that China will dominate the automotive industry, probably in EV in the coming years?
So I'll give you a straightforward answer, and then Charles, you may disagree. Yes in Europe, no in the United States, at least in the near term. And I think Europe was too slow to wake up to the shock, and you can basically see it in the data here. Look what happened from 2020 and 2025. I mean, this was developing quickly during COVID. This is one of the most important stories of the decade so far. China's EV ramp up around the world, but especially toward Europe over the past 5 years. It happened on a scale unlike any kind of export-driven sector to what is the beating heart of Germany's economy. And that happened so quickly, and policymakers were in such a crisis mode over COVID and dealing with everything that would happen. It was hard to address it in real time when they were we got to deal with pandemic, we got to deal with the shock to our economies that are in the near term. While that was happening in 21, 22, 23, look what was happening to Chinese exports. At the same time, those European car companies are, of course, trying to sell cars in China. So this creates all kinds of cross-flow issues. And now you have this interlinkage, which is hard to reverse. And obviously, Europe's trying. You saw the tariffs that came on last year, complicated within the EU system, as Charles can talk about. But the U.S. put up the blockade very quickly. And because we have so little Chinese EVs and we saw the threat and we were isolated from it, it's going to be easier for us in the U.S. to prevent it from escalating. I fear from a European perspective, it may be too late. Perhaps I'm wrong.
You might be right. The test will be in how the policies work. But I agree with everything you said. The reaction was too slow, and still there are gaps in the reaction. So I'll end on a more optimistic note, but I'll start with the gloomy stuff first. Still today in Germany, the auto industry was the beating heart of the of German industry, now in a very bad state. But even today, you have municipalities, including Germany's capital, that put out perfectly normal public tenders for new electric buses that treat these as a normal market where everyone can bid. And you guessed it, the Chinese bidder won. And so even the public purse can be deployed to enable China to get even more of a market share, when that is something that can be deployed more strategically and with certain criteria. And yes, even within rigid EU law, it is possible to make it to promote your national champions. and not have a completely open tender. So if even the public purse is being used to bring in and entrench China's dominance in electric vehicles, including the larger ones like buses, I think that's very poor policy. And it shows you some of the sort of old thinking that still prevails in some member states, like one of your big neighbors. But it's changing quite quickly. And I'd say that the tariffs that Josh mentioned that came in late 2024, those were very painful, and Germany voted against them at the time. We don't need to go into all the coalition dynamics of the time. These were actually quite popular in German public opinion, but because of the political balance in Germany, Germany still voted against, knowing that the tariffs would come in. The tariffs are modest compared to the US, and they also took a lot of time. A lot of economists had to work on studying the individual subsidies that individual brands had received in China so that they could convey these tariffs as countervailing duties that are compliant with the WTO. We don't have that sort of time in the EU, and so we're going to need to move a little bit faster and pass legislation that may not be fully WTO compliant, which is difficult for the EU. The EU is multilateral in its nature, and so it likes multilateral organizations. We're going to have to move a bit faster. The optimistic note I'm coming to at the end is just that there are tools the EU already has that it needs to deploy more forcefully. So your Prime Minister, your newly re-elected Prime Minister, has been critical of some of the EU's environmental policies. And yes, sometimes they have meant that Europe is less competitive than it should be because energy prices are too high. But you can redeploy some of those policies as protectionist measures or temporary protective barriers to say the Chinese industry is still not at the same standards as Europe, and therefore we need to protect our market because of the environmental standards in China. And that's one way you can basically keep Germany on side. Germany will not go along with blanket tariffs that are protectionist. The political consensus isn't there yet, even though public opinion is further ahead. But if you use the environmental tools the EU has, you might get that.
Can I just say one more thing? The cars are good and the cars are cheap. And that's hard to fight against. For a long time, Chinese products were cheap, but they weren't always best in class. With the EVs, you have cheap Chinese products that in many cases are best in class. And that's why I said before, this is a shock unlike anything we've seen in a different Chinese export sector.
Yeah, that's right. And even the car industry is not among the priority industries in the new 5-year plan.
Right.
So they think that the industry has been advanced.
They've arrived.
Yes,
that's right. Yeah, that's right. And we can see that China is moving up the value chain. So the EV is an example of it. And now it's especially heavily investing in semiconductors, of course. It's the worst pain probably for China, and into biotechnology, AI. This is probably the only competitor for United States. And of course, robotics. So here I would have two questions. Whether this let's say transition, because it's to some extent transition within the Chinese economy, whether it can contribute to higher productivity growth in Chinese economy, which was a major problem probably during the real estate boom. And the second question will be whether these new technologies could succeed internationally.
Yeah. Two good questions. So just to step back for a second, how we got here on the semiconductor front. The U.S. triggered a lot of this because of our export controls in the U.S. And there was a debate in the U.S. specifically about this outcome. Many people said, if you put export controls on the semiconductors, this will basically fuel China's homegrown industry in the sector. Certainly that's what happened. My view is that it was still the right thing to do because it is costly for them to do it. It takes years for them to do it, but they are doing it. And they are doing it successfully. It still will take time, and it will be a long time till they catch up to the TSMCs of the world and the broader semiconductor manufacturing. And I think from a U.S. national security perspective, where we think a lot about these issues, that was still the right decision. But no one should be blind to the fact about one of the effects of U.S. policies was creating the homegrown Chinese semiconductor industry, and they will figure out a way to do it over time. Yes, that will contribute to productivity growth, but none of this is in the near term. I mean, none of this is 2-3 years. This is really a 5-year plus for them because to match the global scale of semiconductors and the head start the major players have here, even for China with all its industrial capacity and all the money they're putting into it, is not a market they can match. And it's a domestic market for them, which is a major domestic market. But the international dimension, because of the national security concerns, this will be harder for them to break into. And look, the U.S. is not great at having a strategic policy between administration to administration. Let's just stipulate that point. But on this one point, on semiconductors, the U.S. has actually had a coherent plan for the last 3 or 4 years, which is we're going to align with allies and we're going to have homegrown semiconductor capacity. And we are building quickly on that front. And that will make it harder for China internationally to expand. So that's just a semiconductor specific point, not the broader value chain.
A small risk within that strategy. I agree with Josh's broader strategy that he's outlined, which has been the US strategy. The small risk is that, well, maybe not so small. The logic here is that as a Western alliance, like-minded countries, we have our homegrown AI industry, or we have the chips. Some of that is dependent on tech that isn't in the US. The printers are Japanese, Dutch, but we work together and we have export controls that are pretty tough against China. And then the economy in the US is doing quite well because a lot of these chips are going into new data centers. A lot of hard infrastructure is being built for the AI era, but we haven't yet seen the productivity gains that would justify all of these investments. That's one risk. And then also because of certain risks, certain erratic policies that are befalling the Western alliance, you may see Europe starting to have a bit of a backlash against US tech, trying to use alternatives which don't yet exist. And so let's be clear that right now they're pretty dependent on the US and US tech. But US tech needs the European market, and therefore you do sort of need a sort of political coherence and friendship to continue for this whole model to work. And there are some risks right now on that friendship weighing over it. I'll stop there.
Okay, thank you very much. This really we could talk about it for very long, but unfortunately we have to move forward. I would maybe join these two questions into one. Probably, what is your opinion on the development of renminbi exchange rate? Because PBOC Governor Pan Gongsheng has already declared that China is ready to let the renminbi strengthen, not only against the US dollar, of course. And on the other hand, we can see that on the Chinese markets, capital markets, is something which we haven't seen probably for 10 years when the stocks are rising since 2024, when the government announced its package to support capital and residential market. So how do you see these changes? Is really China ready to let the yuan strengthen? And will be the Chinese capital markets attractive for foreign investors in the coming years?
So it's a great question, and it ties into your first question about the current account. It's all tied together when you think about the trade surplus and how that affects the appreciation and depreciation of the currency. Just on the composite, I think what you're seeing here in 2025 to 26, and we've done some work on this at the Atlantic Council, is a tech-related stock boom in China, not unlike the U.S. tech-related AI stock boom in China, DeepSeek and others fueling growth in Chinese investment. And that is interesting because it will have to be seen what amount of the Chinese economy that actually ends up consuming. So it's a bit of a kind of momentum-driven rally on the DeepSeek announcement that I see happening over the past year in the composite that's bringing up the entire composite, very similar to the U.S. equity markets in that way, where our tech companies are lifting up the rest of the stock market. But as Charles said, we've yet to see the returns on that from a real economy perspective. And in fact, there's a cost on that in a real economy perspective when it comes to the labor market. So there's some risk in the valuation. But I think you're seeing a tech-driven boom here. On the currency, the yuan is underappreciated. It needs to appreciate. I think that's pretty clear macroeconomically.
How much, by the way?
Well, I mean, it's got to go back above the band. I mean, I think it should push the limits of the band of where they are, and they're under the band at this point. So, but my view is Pan Gongsheng has said the right things, but we've yet to see the policy change from a Chinese perspective. So the rhetoric is right, but the policy is not there. And we see all the intentionality. And Pan Gongsheng said a few months ago, he said, we want internationalization of the renminbi. We want multipolarity, right? We want more renminbi. We want more euro. We want a little less dollar. I understand China's intention of that. I understand why they would want that. But to do that, you have to have a fairly valuated currency. currency. And I'm not talking about free-floating exchange rate here. I'm just talking about a little recalibration of the currency from where it is. And we just don't see it yet in the data. And I think the reason is that they would say internally, we wanted to do it, but then we came under the tariff pressure. We came under all the volatility of the past year, and we had to revert a little bit to what the plans were. Maybe that's an excuse, maybe that's reality, maybe it's a little of both. But the bottom line is you just don't see appreciation happening despite all of the macroeconomic indicators that say it should. And I think from a U.S. perspective, you're going to hear more and more calling out on this front, where the U.S. has been pretty quiet in recent years about calling out China's valuation. I think that's changing a little bit from where we talk to people in Washington.
Nothing to add.
Okay. So the last question will be, we have a new 5-year plan out. It has been approved by a National Congress. So it's final. And my question is, what would you advise the Beijing leaders? What should China do to ensure that its economy prosper in the future? Is it a good recipe? Or do you see the good recipes in the 5-year plan?
Good recipe.
Yeah,
recipe, sorry.
You want to start, Charles? I like this practice of advising Chinese leaders. We don't typically do that, so it might shift.
Well, we know they read our articles.
That's true.
So this is a different channel through which we can speak to them. Where to start? Taking my time to think, to find something to bounce off.
Maybe Josh can start.
Well, he started a few times. I think he wants a break.
Okay.
Yeah, so I can disagree with him, so it's more fun for me.
And luckily we're not live, so we can take our time. So what I remembered from the coverage of this was something we've already seen, but there was a continuation of the instructions to provinces and factories to lay off on some of the subsidies, to pull back a little bit. So we've discussed during this podcast already that they're on a sort of path dependency. It's very difficult for them to pull out of the reliance on exports and what we call overcapacity, because their consumer market isn't large enough to absorb what they're producing. You don't see it here necessarily. Here you see a more traditional managed approach to the economy, which is culture, part of the CCP's culture. So they have to keep doing these things, and the way it's presented is very aesthetically CCP. Not too surprising.
It's by Global Times.
I know.
I can see the coloring.
But there you are. It's the approach to how you talk about the economy, I'd say, is still pretty traditional, whereas the Chinese economy is now very market-driven and very diversified and very large, and has all sorts of different players that have to negotiate with each other. So, the first question is it even relevant to set these targets at this point? They've been very useful over the years, but is it even still relevant? They are still a window through which you can read things about the Chinese economy. And so that's where the economic growth target is very important. They've pulled it back over the years. It used to be at least 7%, and it was almost seen as tragic when China didn't reach its 7%. And then there was a lot.
It's normal that you're setting down.
Well, it's normal, but they're actually accepting that they're doing it. They're putting it out there. This, the headline is smaller, and the question is, even given that it's now slower, maybe they could start actually converging with the real rate of growth, which we believe is but quite a bit below 4.5 to 5%. So if you're going to bring down your growth targets, which is a normal part of the economic development cycle, you might actually want to converge with the reality. So that would be one point I'd make. Otherwise, these things are pretty easy to recognize. New urban jobs, that's a trend we've seen for a long time. And they're still wanting to concentrate people in the urban areas of China, which are pretty sprawling, pretty big. But that's, the growth target is what is the most striking and the newest to me. Leave it to you.
Yeah, I agree on the growth target. It's important that it's gone down because we know that China always hits the growth target at 5, even if they grow below 5. So the fact that they feel like they can't even manage to reconcile that publicly, given where that is a shift of where we think they are actually. But more broadly, and this is not just for China, this is for the U.S. and any economy, this is a nice plan and a nice infographic. But we're dealing with the world on fire at the moment. And if you just think about what's happening with China vis-a-vis with the Gulf and oil and energy, of China's top 10 oil imports, or the countries that exported them, 9 of them are involved in open conflict right now, whether it's Venezuela or the Gulf countries or Russia. Brazil's the only one that's not in a war of the energy shippers to China right now. And I share that in a sense of this is a different macroeconomic environment than China planned for 6 months ago. It's a different macroeconomic environment than most countries planned for 6 months ago. And they fear for a long time this concept of isolation, the idea of being too reliant on any one supplier of energy, and not just energy, but foodstuffs, all of the things that they need for the economy to run. And I think what is happening inside China right now is a realization of a lot of their fears over the long time when they see what's happening around the world, when they see how the U.S. is acting around the world. And so nice on paper, but I think the reality is going to look very different on many fronts.
Okay, so that's all. Thank you very much for your great answers. It was a great pleasure to have you here, Josh Lipsky and Charles Litchfield from Atlantic Council.
Thank you. Thanks for having us.